We're going to get started by looking at the macroeconomic outlook for Sub-Saharan Africa. To begin, we'll look at the region's performance during the pandemic. We'll also touch on some of the key drivers of the outlook and provide an overview of the key market growth trajectories in 2022. We'll also take stock of how the pandemic has created a bit of an economic shortfall for many countries in Sub-Saharan Africa and how this is affecting the prospects for the region. So when we look at 2020, it certainly was a difficult year for Sub-Saharan Africa, with most markets posting very sharp contractions during the second quarter. However, as full year data has trickled through, we have seen a clear trend emerging, and that is specifically that economies began to rebound from the third quarter. This trend was sustained well into H1 2021, and what we have seen is sustained recoveries across the region. There are two main reasons for the rebound. Firstly, we have seen a relatively early relaxation of COVID-19 related commercial restrictions last year as governments decided to avoid strict lockdowns, partly to stimulate economic recoveries, but also globally we have seen an upswing in commodity prices, which has supported export revenues and in some cases government revenues across Sub-Saharan Africa. There are two clear exceptions, however, or three clear exceptions. So South Africa, Angola, and Zambia, all three countries have faced prolonged downturns, partly because of their structural economic problems, which has meant that they entered the pandemic from a position of weakness, and they have struggled to deliver growth through H1 2021. South Africa's economy did grow by 19% year on year in the second quarter, but bear in mind this is after an extremely sharp contraction in Q2 last year, so this comes from a very low base. When looking at the drivers of the region's outlook in 2022, on balance, Sub-Saharan Africa will benefit from mostly positive drivers. Very broadly, the most significant drivers of growth relate to global economic performance, whereas there are several domestic and regional factors that will constrain growth potential over the coming year, most specifically fiscal pressures. So many Sub-Saharan African governments are facing quite considerable fiscal pressures that will prevent governments from raising spending and investment over the course of the year. This was a key driver of growth before the pandemic, so this certainly will weigh on growth prospects going forwards. However, as we can see, the global environment is broadly very supportive for Sub-Saharan Africa. Upbeat prospects in Europe, North America, and Asia, including China, have been a growth driver, a key growth driver for Sub-Saharan Africa in 2021, and will continue to support demand for Sub-Saharan Africa's exports in 2022. Demand for SSA's commodity exports, as well as investment levels into Sub-Saharan Africa, will continue to grow, and we are also expecting to see an indirect benefit from higher remittances from the African diaspora in Europe, North America, Asia, for example, as those economies recover. So certainly the global growth story does support the growth trajectory of Sub-Saharan Africa. However, Sub-Saharan Africa is very exposed to commodity prices, and it will be a major driver. Commodity prices will remain a major driver for the region's growth outlook. And so starting with oil, we have revised up our average oil price forecast for 2022 from $60 a barrel a few months ago, closer to $66, $67 a barrel through the rest of this year. This is mainly because of strong upticks in demand, especially in Europe, North America, and Asia. And we have seen this accelerate faster than we previously expected. Supply growth is improving, but we don't expect it to outstrip demand growth. So certainly we have revised up our oil price forecast going forward. There are prospects for an easing slightly in the oil price in the end of 2022, but we do not expect oil prices to fall significantly, especially to the lows that we saw in 2020. The impact of this oil price outlook is that we are unlikely to see a sharp slowdown in export revenues from oil exporters, for example, Angola and Nigeria. But unfortunately, prices will not be high enough to sustain economic rebounds in these countries that are dependent on oil. Other countries that will be affected include Ghana, that has become increasingly dependent on oil for government revenues, for example. Conversely, oil importers, including South Africa, Kenya, for example, will benefit from moderating imported fuel prices. We have seen a spike in fuel price inflation in many markets in Sub-Saharan Africa over the last few months because of higher global oil prices, but we are expecting this to wane quite considerably into 2022, putting downward pressure on inflation. So certainly a bit of a positive story there. When we look at non-oil commodities, after a substantial upswing in late 2020 that has driven export revenues across Sub-Saharan Africa, we are expecting commodity prices to begin softening in 2022. And this is because global supply disruptions and backlogs for production for manufactured goods in Asia, North America, and Europe will begin easing, in our view, over the course of next year. So this will put some downward pressure on commodity prices, but we don't expect them to fall to levels seen in early 2020, given the robust nature of the global economic rebound. So certainly, on balance, we are expecting global commodity prices to continue to support export growth and investment into Sub-Saharan Africa. Turning to coronavirus, this is something that we can't avoid discussing, and it will remain a major driver for Sub-Saharan Africa in 2022. When we look at vaccination rates, on the surface, Sub-Saharan Africa doesn't seem to be performing particularly well. So most countries in the region have significantly lagged behind Europe, North America, and even Asia to an extent. We have a couple of positive outliers. So South Africa and Zimbabwe have recently seen a surge in vaccination rates, but unfortunately, we're not expecting any Sub-Saharan African market to vaccinate more than 50% of their populations fully by the end of 2022. While there is likely to be an upswing in COVAX-sourced doses arriving in Sub-Saharan Africa over the coming months, thanks to improved supplies from India, Sub-Saharan Africa will certainly continue to lag from a vaccination perspective. What this means for Sub-Saharan Africa is we expect the region to remain vulnerable, or more vulnerable than other regions, to future waves of COVID, potentially new variants of COVID. And we also expect the region to remain quite isolated from a travel perspective. So this will have impacts on tourism, business travel, as well as multinationals' ability to travel to the region to meet local partners and customers. But we do not expect it to derail the growth outlook for Sub-Saharan Africa. And this is because most Sub-Saharan African governments will continue to pursue a relatively open approach to COVID-19 restrictions. We don't expect there to be significant risk of commercial disruption, at least in the form of government lockdown rules. And this is because governments will continue to strive to preserve economic recoveries, and also because they lack the physical capacity to support economies through a renewed period of lockdowns. We've also seen relatively low COVID cases and deaths by global standards, even once you take into account low testing rates and monitoring of the disease in Sub-Saharan Africa. There certainly is a risk of a cycle of tightening and loosening of restrictions. We have seen this in South Africa, for example, where the government has raised COVID restrictions in response to higher caseloads and tightened curfews, for example, but we certainly do not expect a complete shutting down of economies across the region. So overall, we are expecting COVID to perform to form a relatively minor constrainer on growth going forwards. Another major driver for the region's outlook in 2022 is the political and security landscape. I would like to emphasize that over the last 6 months or so, there has been an intensification of political and security risks across Sub-Saharan Africa. So certainly a couple of markets are worth highlighting. As we all know, in South Africa, the country experienced quite considerable unrest in July, and this has prompted us to downgrade our growth view for 2021 and 2022 because of the negative impacts on public finances, foreign direct investment, and unemployment. We also expect the government's reforms, the president's pro-business economic reforms, to stall over the next few months. We certainly don't expect to see a repeat of the violence on the same scale in the future, but there's now elevated risk of short-term disruption, especially around election time. For example, we have local elections coming up in October. So bear in mind that these do present a risk. But specifically, there are a couple of other markets worth noting or worth monitoring more closely over the next 6 months or so. For example, in Nigeria, there has been a steady deterioration in rural insecurity, which we expect will get worse in 2022. And there's also an increased risk of disruption related to secessionist movements across the country, as well as militant activity in the Niger Delta. Of course, most urban areas won't be directly affected, but we are expecting consumer and business sentiment to be curtailed, especially in rural areas. Companies will struggle to reach customers in rural areas, for example. Kenya also has an increased risk of election-related disruption ahead of the 2022 elections, which means that the third quarter of 2022 could potentially be quite difficult for multinationals looking ahead. So we would advise monitoring the situation very carefully and supporting local partners in Kenya during the third quarter next year. Additionally, we've also seen an escalation of violence in northern Ethiopia and the far north of Mozambique. Both are likely to deteriorate before they improve, so we have downgraded our growth views for both these markets, and there is prospect for additional downgrading looking ahead. I will, however, to finish off, emphasize that there are a couple of markets where political risks are actually easing and improving. And so multinationals can look forward to a more stable environment in these markets, and that includes Cote d'Ivoire, Ghana, and Zambia. All three markets had elections recently. In Cote d'Ivoire and Zambia in particular, there was quite a lot of anxiety around the elections, but there has been a considerable easing of political tensions in all three markets, and we are expecting improved stability and investor sentiment as a result going forward.